Welcome back to Wealth Locked In, the channel where we go deep into the structures that actually protect your assets, your family, and the wealth you're building for generations. And today, we're talking about the role inside your trust that makes sure the administration never collapses, the executive secretary. Now, if you're an entrepreneur, a family-minded individual, or someone who understands that ownership in your own name is a liability, this is the video that closes that gap. Because here's the reality most trust educators never address. You can have the most legally sound trust document in existence and it still will underperform if the financial management function is not clearly assigned, properly executed, and consistently maintained. But here's the operational reality. Trustees are human beings with jobs, businesses, families, and schedules. And unless someone is designed to track the financial details with precision and consistency, those details get missed, not out of negligence, out of the natural chaos of life. This is where the executive secretary becomes indispensable, not as support staff, but as the operational backbone of the trust financial function. Do remember, the executive secretary is a function, not a person. So therefore, you can't assign this particular role to an individual. It's up to you. One of the most critical responsibilities this role carries is monitoring whether the accountants are actually doing their job. Because your trust accountants are responsible for preparing financial statements, monthly, quarterly, and year-end. These are not optional documents. These statements are the financial record of your trust activity. They document stewardship. They document compliance. They document the trust health. And here's the requirement that most people running trust don't know. Those financial statements must be attached to the agenda of every board of trustee meeting. Not emailed separately, not referenced verbally, attached. And they must be kept in their most current form, available for review at any point when needed. Records kept in the ordinary course of business are business records. Who makes sure that happens? The executive secretary. Not because the trustees are incapable, but because someone has to own that function. And the executive secretary is the one positioned to own it. If the accountants haven't delivered the monthly statements before a board meeting is scheduled, the executive secretary is the first one to notice, the first one to escalate, and the one who ensures the meeting doesn't proceed on incomplete financial information. That is administrative work. That is governance. And governance is what separates a trust that holds and protects wealth from a trust that quietly erodes it. Now let's talk about financial correspondence, because this is where a lot of trust operations develop blind spots. Financial correspondence covers a wide range of communication: bank notifications, brokerage statements, IRS correspondence, accountant communications, investment account updates, insurance documentation related to trust assets, and any formal communication from a financial institution that holds trust property or trust accounts. The primary responsibility for responding to and directing this correspondence belongs to the trustees and the accountants. That's by design. The trustees hold the authority. The accountants manage the reporting. The executive secretary is not the decision maker here, but the executive secretary must be aware. And that distinction, the difference between being a decision maker and being aware, is what most people miss when they think about this role. When a trustee is traveling and a time-sensitive notice arrives from a financial institution, someone needs to know where that document belongs, who needs to see it, and what the deadline is. When an accountant misses a quarterly filing notification, someone needs to catch that before it becomes a compliance problem. When correspondence arrives that affects a specific trust account, someone needs to connect that correspondence to the right financial statement, the right trustee, and the right action. That someone is, you guessed it, the executive secretary. This is what I mean by the awareness function. The executive secretary doesn't need to understand every financial instrument inside the trust, but they need to understand the landscape, who holds what accounts, what the reporting timelines are, which institutions the trust works with, and how to locate the relevant documentation at a moment's notice. Because in a trust structure designed to protect your wealth across years and decades, the ability to act quickly on financial correspondence is not a nice to have. It is a protective function. Every missed deadline, every misrouted document, every unanswered bank inquiry is a crack in the structure. The executive secretary's job is to make sure those cracks never open. If you're picking up what I'm putting down, subscribe to Wealth Locked In right now so you never miss a breakdown like this one. Stay locked into this video all the way through, because what's coming next on Signature Authority is the most operationally important thing we'll cover today. And when you're ready to go deeper, join the school community waitlist. Download the free What is a Trust ebook linked in the description and grab the trust book checklist pinned in the comments. Here we go. This is the section I want you to pay close attention to, because everything we've covered so far, financial statements, correspondence, awareness, accounting oversight, it all becomes meaningless if signature authority isn't managed correctly. Here's what signature authority means inside a trust. When your trust holds accounts at banks, brokerage firms, or other financial institutions, specific individuals must be formally authorized to sign on behalf of the trust for those accounts. Not everyone with the role in the trust has signing authority, and not everyone with signing authority has it across all accounts. This is where you can get clever, and this is where most trust operations get dangerously vague. And vague in a financial structure designed to protect assets is the same as exposed. Let me give you a concrete example. Your trust has 3 trustees. You have a primary operating bank account, a brokerage account, and an investment account. Each one of those accounts may have completely different signature requirements, and they should. The operating bank account might require signature from 2 specific trustees, say trustee A and trustee B. The brokerage account might require signatures from a different combination, say trustee A and then trustee C. The investment account might require all 3 trustees, A, B, and C, to authorize any movement of funds. Now, a transaction needs to happen quickly. A tentative, time-sensitive investment opportunity, a vendor payment from a trust account, a transfer between accounts. Who signs? For which account? Are the authorization documents on file with that institution still current? Has there been a trustee change that was never formally updated with the brokerage? If the executive secretary doesn't have clear documented current answers to every one of those questions, the trust does not function in the way it was designed to. And that's not a legal problem. That's an operational failure. The executive secretary must have proper authorization documents ready at all times, not filed away somewhere, ready. That means knowing which institutions hold trust accounts, which trustees are authorized to sign at each institution, what specific signature combinations are required per account, and whether all of the information is current as of today. And this isn't a one-time task. Trustees change, accounts change, they should. Financial institutions update their authorization requirement. The executive secretary owns the ongoing maintenance of this information, making sure every access point in the trust financial infrastructure is clearly documented, properly authorized, and never out of date. This is the level of operational discipline that makes a trust function like a well-run institution. This is what it looks like when financial control is actually managed, not assumed. Let's step back and look at why all of this matters from a structural level. You build a trust, or you're building one, because you understand something most people never figure out: personal ownership is a liability. When your name is on assets, those assets are exposed. Y'all know I know. Exposed to lawsuits. Y'all know I know. Exposed to creditors. Exposed to probate courts. Exposed to public record. Exposed to every system designed to extract from individuals who hold property in their own name. I know. If you never heard this before, you probably like, what? That's how I was. December 2019, that's how I was. How? How can you just take my money? Because it was in my name, my personal name, that's why. And I don't want that to happen to you. Unless you want it to happen to you, then you probably wouldn't be watching this channel and this video all the way through if you don't mind your property being taken from you. A trust is designed to remove your name from the equation entirely. Control without ownership, privacy without secrecy, structure without restriction. That is the power of a properly designed private express trust. But here's what that power requires in order to uphold. The trust must be administered correct, and correct administration is proven through documentation. The financial statements prove stewardship. The correspondence records prove responsiveness. The signature authority documentation proves proper execution. These aren't bureaucratic details. They are the evidence that your trust is real, functional, and operating with integrity. When a challenge comes, and in asset protection, challenges come. The evidence is what stands between your wealth and whoever is trying to reach it. A trust with clean financial records, current authorization documents, and a well-maintained correspondence file is a trust that can defend itself. A trust with gaps, outdated records, and unclear signing authority is a trust that creates opportunity for the very challenges it was designed to prevent. The executive secretary role exists to close every one of those gaps. This is the person who ensures the financial infrastructure of your trust is never the weak point. Whether you fill this role yourself, delegate it to someone inside your structure, or build systems around it, you need to take it seriously. Here's exactly what to do right now. Subscribe to Wealth Locked In so you never miss a video in this series. Watch this full video from the beginning. Join the school community waitlist where we go deeper than any YouTube video can take you. Download the free What is a Trust ebook in the description because that's your foundation before you take any next step, and get the trust book checklist pinned in the comments because it tells you precisely what documents needs to be in place for your trust to operate the way it was designed to. Everything you need is here. Use it. In the next video, we're going deep on how Board of Trustee meetings actually work inside a private trust and who has the authority to call them, what must be on the agenda, how resolutions get passed, and why the minutes from those meetings are one of the most legally significant documents your trust will ever produce. That video is going to completely change how you understand decision making, especially inside a trust structure. Stay locked in, and I'll see you in the next one, which is the last one on the executive secretary, number 6. Peace.